Okay, Chapter 10, Financial Accounting. This is the first video. We're going to talk about current liabilities, talk about accounts payable and some accruals, and also talk about discounted notes. So, okay. So the first thing it talks about is short-term notes payable. Now, in prior chapters, we talked about short-term receivables, and we talked about how if a customer might not be able to pay us, that we could choose to allow them some extra time to pay. But we generally, a lot of times, would charge some interest and thus create a note in this case. So what we're talking about in this chapter is the opposite side of that. So what happens if I'm the customer and I owe somebody money and I can't quite afford to do that right this second, and I say, hey, can I have a little extra time? And they say, well, sure, but we're going to have, you're going to owe us some interest on this because you're not paying us on time, and we come to an agreement. So the example it says on Chapter 10 is it shows, assume that Nature Sunshine Company issues a 90-day 12% note for $1,000 dated August 1st to Murray Co. for a $1,000 overdue account. So effectively, they're issuing a note so that they can give us more time to pay, and it's a 90-day 12% note for $1,000. So the first thing we need to do is we need to get out of the accounts payable that we say that we owe right now and move it over to our notes payable, because we are going to end up paying them interest after we sign this note. So we would debit accounts payable for 1,000 to take it out of there, and credit notes payable for 1,000 to put into there. Now, I set one of these up for the last chapter. I'll go through it quickly again, but that's a pretty simple calculation. Remember, the calculation to find interest is the interest amount equals face amount times the term divided by the whole year. In this case, 360 is what we use, just because that's what the book uses, times the interest rate. So I've done that in this form here. So in this case, we've got face amount of $1,000, term of 90, annual interest rate is a given at 12%. So this total interest function right here is just doing exactly that. It's taking $1,000, which is the face amount, times 90 divided by 360. And then times the interest rate of 12%, which gives me $30 worth of interest. So when I actually pay this, down the road, I would debit notes payable for 1,000, because there's only 1,000 in there. I can't debit it for more than that. But how much am I actually going to pay? Well, the actual pay is going to be the $1,000 plus the $30 in interest. So my credit to cash is $1,030. So the difference between those two is interest. In this case, since I'm the one paying the interest and not the one that is receiving the interest, it's not interest revenue, it is interest expense. So that's what it would look like. And there's a good, Exhibit 1 is a good transaction between borrower and creditor. Just realize this one we're talking about being the one that borrows, whereas in prior chapter we talked about it being a receivable, someone borrowing from us. So this also could be the case if we have, if we take out a cash loan. It really would work pretty much the same way. So we have one down at the bottom of 479 that says, in September 19th, Iceberg borrowed cash from First National Bank, issuing a $4,000 90-day 15% note to the bank. The entry record the issuance is as follows. So if this is a cash loan, then I'm receiving cash of $4,000. I now owe $4,000 notes payable. 4,000 is increased by $4,000. And when I actually pay it, there's going to be some interest. So I'm going to plug this back into my calculator. 4,000. It is a 90-day term, 15% interest. So I'm going to owe a total of $150. When I actually pay this off later, I'm going to debit notes payable for $4,000 to get rid of the note payable and no longer owe them that money. I'm going to debit interest expense for the interest of $150 in this case. And I'm going to credit cash, because this is how much cash actually coming out of my pocket, for the total of those two, $4,150. Now, there is another note called a discounted note, and discounted note is a little bit different. So This is a normal note where I would receive $4,000 and owe $4,000 plus interest of $150 at the end of the term. But another way they can do this is instead of giving me the full amount, they can take the interest out up front, which is called a discount or a discounted note. So in this case, if everything was the same, if this one were a discounted note, I wouldn't receive $4,000 right here. Sorry, I wouldn't receive $4,000 in cash. I'd receive $4,000 minus $150. And then when I actually paid it off, I would just pay the flat $4,000. So let's go through an example of one of those. I do have another calculator down here to show kind of how that works. So we have a discounted note on page 480. It says, on August 10th, Carey Company issues a $20,000 90-day discounted note. So we know it's $20,000. We know it's 90 days, and the discount rate is 15%. The initial date is August 10th. If we wanted to know the end date, we can do that. So what is this going to look like? Well, on a discounted note, by definition, I'm not going to receive all $20,000 in cash. I'm going to instead receive $20,000 minus the interest, okay, of $750. But I do owe $20,000 at the end of this. So in this case, I'm going to book the interest expense up front for $750. And the back end is going to be the notes payable, $20,000. Then when I actually pay this off, it's going to simply be notes payable. This will be on November 8th. Notes payable is debited for $20,000. And then the in cash is credited for $20,000. So that is short-term notes, converting one accounts payable to notes payable, and then also discounted notes and how those work.